Hello, everyone. Welcome to the Klaas Financial 2023 Quarter 3 Client Webinar. We expect our presentation today to last about 30 minutes, and then we will have hopefully some time for Q&A there at the end. I am Eric Schwartz. I'm one of the advisors here in our Madison office, and I am joined by Josh Stirling, our Director of Portfolio Management, and Kite, who is our CFO and also one of our advisors in the Loves Park office. Just to kick things off here, just a little bit of housekeeping for folks who may be new to the webinar or may not know about our firm. We have been in business about 47 years, and we help individuals and families with comprehensive financial planning and investment advice. We also provide employers with assistance in managing retirement plans for their employees. We serve over 1,000 households across 32 states, and we manage, give or take, depending what the market's doing, about $627 million in client assets. We serve clients from two primary offices, one up here in Madison and one in Loves Park. And we currently have 18 employees here on staff. So just diving right into two things here, I think one of the things that has really stuck out to me this quarter is the inconsistent data we've been getting. So we get inundated, we being consumers, but also the market is inundated with producer price index reports, consumer price index reports, jobs reports. It feels like there's a new one every single week, multiple times a week. And generally we can sort of string together some sort of consistent trend when we're looking week to week or month to month at these things. But for me, at least, it's felt like we're getting kind of numbers all over the board. You know, one month we get a jobs report that just blows expectations out of the water, and you know, suddenly everybody's worried the economy is still too hot. And then the next month we greatly underperform with what's expected in terms of new jobs being created, and suddenly the economy is slowing down way too much. So it's just been creating a lot of noise, and it's, I mean, I think at least it's making the market move a bit, and we're seeing quite a bit of volatility, especially this quarter.
And we see a lot of that. I mean, it necessarily shouldn't be a surprise about it, right? Because for those of us that have been listening to the Fed, and I've been right there, I've been listening to the Fed for a little bit, they've kind of talked about this a bit, about how they're waiting for data to kind of feed into the market before they really make more rash decisions than they've been making past 12 to 24 months. And we're starting to see the reality of that kind of as the corner turns, or turn around the corner. You start seeing just odd numbers. Things don't align perfectly. It takes time for things to flush out, right?
Yeah, you really start to look at things and you almost see outlier data, and it's sort of indicative of things working their way through the economy. The other thing that we're starting to see, and this feeds into the discussion of inflation and Fed policy, is we are seeing oil prices start to creep up again. OPEC has cut production to control, well, to pump up the cost of crude oil and protect their economies. So we're starting to see that creep in. We're also seeing consistent demand for fuel. That's not really something that tends to vary too much. So those two things together, we're starting to see oil prices rising, and fuel is a big piece of the CPI, right? So as the Fed is looking at decisions around raising rates and how they want to approach that, we're definitely seeing an impact from that rise in oil prices.
Yeah, and not only that, but also just the conflicts happening overseas. All of those coming out, right? They start bottling up, and the unknown future kind of leads to higher prices as well. It always comes from multiple sources, not just one big event that causes major price increases.
Yeah, definitely. definitely. Now, on the inflation front, we have had some bit of good news here. Core CPI, which is the consumer price index, minus food and minus energy, that has been consistently continuing to decline. And we're going to talk more about that, and just inflation in general, but also, how close we might be getting to that Fed goal of 2% inflation.
I feel like we've heard so much about it the past 2 or 3 years. We'll get back down to 2%.
Yeah, so as Eric was kind of alluding to here, so this chart here on the screen is really tracking two different, it's CPI, which is kind of headline inflation. If you see that word out there, that's tracking just the regular CPI. Core CPI, that is one that the Fed generally tracks a little bit closer. That's the one that influences their decisions a little bit more, because core CPI actually takes out the cost of oil and food, which can be the most volatile ones. Obviously, they're kind of interlinked in that if oil's higher, it costs more to get your groceries to the grocery store, all that kind of stuff, which is going to drive food prices as well. So that's part of the reason why the Fed focuses on core CPI, is just to pull out some of those more volatile variables. But as we'll talk about today, there's a lot that goes into both of these numbers, and that's where we'll spend a good portion of our call today focusing on. Yeah, so the big one here that's kind of hitting everybody in the face is that housing. So housing has been kind of the big thing out there that everybody was, worried the most about, is that these raising interest rates were going to blow up the housing market, right? While it hasn't blown up, it's certainly kind of lagged to a halt here recently, but you can see that it has really lagged the rest of the CPI numbers. So there's about a 6 to 7, 8 month lag here. So we're just now starting to see this come down, which shelter includes not just, purchasing a house, but also rental costs and things like that. So rent costs were going through the roof there over the last year and things like that. This is finally starting to cool off, and you're starting to see that in some of the data.
And shelter, sometimes I don't think gets accounted for as being one of the biggest proponents of what inflation makes up. We were looking at the numbers just before this, Kyle. What was it? 35% of CPI is weighted towards just shelter housing. And it's by far one of the biggest components of the overall CPI calculation. And it's one of the big reasons why you see inflation just sticking really high, is because it's such a big part of it.
Yeah, and it's interesting, like you said, Josh, 35% is about what it accounts for as far as the calculation in CPI, but it also accounts for like 35% of people's budgets. So it's honestly weighted pretty fairly, and that housing has a huge input on people's budgets month to month and things like that, especially people with mortgages and shopping for houses and those types of things.
Mm-hmm. Speaking of mortgage.
Yeah, go ahead, Josh. I said the next chart is the one that we really want to look at, because it's really interesting to see how much this plays into it. So if you take out shelter costs that we were just talking about, so housing and rental costs mostly, if you pull that out of CPI, again, it's about 35% of the overall reading. You can see that back in June, we actually kind of bottomed out, but even though it started to come up slightly here, you'll see that we're still well within that Fed's 2% range, again, if you take out the shelter costs. So this is the kind of why you get this feeling that the housing market is kind of stubborn, and that it's just kind of staying up there. And obviously, like we've talked about, it's mostly because it just takes a long time for this to flush through the system. And also people we've been spoiled with lower interest rates for a very long time right now. So the whole housing market is kind of a supply story, meaning that there's not a ton of houses for sale. I'm sure those of you that have known people selling houses, looking for houses, if you have a decent house in decent shape, you're still getting a premium price for it, but it's still hard to find a good replacement out there. And that replacement is a lot more expensive than it was 18, 24 months ago. So again, the housing market's just kind of being stubborn. But if you take that out, you notice that the inflation costs have really, really come down at this point.
So mission accomplished then. We're at 2%.
Well, I don't know. I feel like, well, people feel stuck in their house, right? I mean, being able to get up and move is no longer as easy when interest rates are at, is it 7.7?
Yeah, I think we almost hit 8 yesterday.
Almost hit 8 now. I mean, it's just become such a barrier for people either entering the market or even just looking to sell their home, but maintaining a mortgage going to the new home.
Right. Yeah, it's like we said, it's a supply side story that really isn't getting any better because people that locked in a house 5 years ago at 3% mortgages, they almost can't afford to move right now because now you're giving up your 3% mortgage and the next house you want to buy is a lot more expensive. So people aren't going to flood the market with houses in this market either. So this is going to continue to be kind of a talking point over the next probably 6-8 months of how this all kind of flushes out. So.
Yeah. Kyle, before we move on, would you mind touching on kind of the comparison between 2008, 2009 to today? I mean, is it even comparable?
Yeah, I would say it's not really that comparable. When you go through tragedies, I guess you would call 2008 a tragedy, but just like in the Depression, right? So when we had the Great Depression back in 28 and 29, that implemented a bunch of banking laws and regulations so that that didn't happen again. Similar thing happened after 2008 and 2009, where the underwriting of mortgages and things like that have become much more stringent and much more reasonable, I would say. So what we have today is nothing like 2008 in that you really don't have people over levered, taking out big mortgages without the jobs to, pay the mortgages, that kind of stuff. So it's really not a comparable thing anymore. And like I said, the majority of that is due to underwriting and that they're not just giving mortgages out to everybody like they were back in 2008. So.
Well, it's certainly an interesting economic situation that's playing out, but we're going to have more information in the next 3 months, 12 months. And yeah, we'll see how things play out here. One thing that we want to kind of touch on next. So this is a pretty fair question that we receive a lot and a topic that we want to spend a good considerable amount of time on. We want to talk about kind of the rationale for stocks. And we think it's a fair question because you look at the current environment that's out there right now. CDs are paying 5% or more. Bonds, if you get the right bond, could be paying 6-8%. And you kind of get to a spot where you need to pause and say, well, why am I taking on equity risk when I can just go get a premium that's going to pay me super well for the foreseeable future and I'll be fine in retirement? And it's a very logical question to come with. And we want to pause and kind of really drill in on this, really kind of approach it and say, hey, there's a reason for having equity ownership within your portfolio and why you should maintain that over a long period of time. So we're going to break this down to a couple of different pieces. We'll kind of start off here talking about banks and bonds, fixed income. We'll kind of talk through those pieces and kind of the practical approach to that. But then we'll talk through kind of the historical averages that we've seen bonds compared to the stock market. And then Eric has a fantastic slide to go over at the end that's really going to focus in on the impact of equity ownership throughout your retirement. So a quick bit of framing on kind of financial institutions before I discuss this slide here. Banks, of course, are a very, very critical piece to our clients' financial lives and to just the financial plan that you implement now and in the future, that whether that's daily transactions, holding on to actual extra cash reserves, your emergency reserve, getting mortgages, loans. It's a crucial institution. The framework that we're looking at this slide in is, well, what if I just sold everything and just put it all into CDs or all into my savings account because I'm getting such a high yield there? And we look at that saying there's power and diversification over a very long period of time, but let's pause and actually look at that from a practical standpoint. And banks sometimes can be not the easiest to work with some of these accessible tools that they have and that they advertise. One key thing is savings accounts, high yield savings accounts. Right now, you could go out and you could find a high yield savings account that's paying 4.5%, 5%, even 5.25% was the highest that I could find. However, if you went out to your local bank that you have right now, you went out to their retail front and went and talked to them and said, hey, I'd like to move all my money into your highest yield savings account, has FDIC insurance, and I can just put my money there and access it whenever. You're probably going to find out that yield is maybe 0.5%, maybe 0.75% or 1%. but it's not going to be these large percentages that you're hearing about. And that's just because of the accessibility of the bank, what they have access to, and what they're willing to provide. And that's okay. Some banks just simply don't have those high yield savings accounts. But if you actually wanted to access those, one of the easiest ways to do that is with online banks. Now you can go and you can open up an online bank, open up that high yield savings account, move money in there, call it your emergency reserve, whether that's 20,000, 50,000, 100,000, whatever it is, you can move it in there. You can get some nice yields over a certain amounts of time frame. But the reality is sometimes that can be a teaser rate as well. That rate could come down in the future. You don't get any benefit from that rate going down in a savings account. In addition to that, if rates continue to increase, there's a likely chance that that online bank where you move the money to originally no longer provides that competitive rate out the market. So if you play the game of online banks, sometimes you might have to check up on that every 3 to 6 months to make sure you're still getting that competitive rate. So coming from a practical standpoint, it can be really hard to move all your money into a savings account that gets you a competitive rate and that stays there over a 20, 30-year time frame.
Yeah, I think what you're getting at is we're at a moment in time where deposit rates are pretty attractive, actually. But we are coming out of a, call it 14-year period where they were not very attractive, right? And as we're looking at, someone might say, well, why don't I just go to the bank right now, leave my money there as long as rates are high, and then I'll come back to my diversified investment portfolio when things change. I think the first thing I'd ask is, well, when are things going to change? When are you going to know it's the right time to be done with the security and the interest rate of the banks and come back to your investment portfolio? It comes back to this idea of timing the market, and it's just not anything that we think is successful at a high rate over time.
Mm-hmm. And in addition to that, one other thing that we always get asked about is CDs. And CDs are an incredible tool. They get you FDIC insurance. They have some competitive rates. But in addition to kind of the high yield savings account and accessibility to it, if you go to your local bank, you'll find that they might have 1 or 2 options, maybe a 6-month, maybe a 13-month, that have that competitive 5% or 5.5%, whatever it may be. But then let's say you want to get a 2-year or 3-year or 4-year CD because you know you're not going to need it. You suddenly see that they're only offering 0.5% or 1% on that. And that's just with the way that banks work with developing CDs to give out to their customers. And that's why here at Klaas, we actually use a platform where we can go out and get CDs from any bank that we choose to work with. That gets you FDIC insurance, that gets you a competitive rate, no matter the maturity range that you're looking for. It's a unique piece behind the scenes of banks and how they work, but make sure you know and are aware of the different rates that are at the bank. And if you're rolling one over, that you look to see if there's good competitive rates still there. Or maybe that's something that we can help out with as well.
Yeah, I think it's interesting too. We're having a different conversation now than we weren't 18 months ago, right? 18 months ago, it was how much, if you have cash in the bank, it's essentially earning 0. Whereas now, if you have cash in the bank, can we put that to work in a better spot? And that's where we're actually seeing things. Yes, high yield savings accounts, short-term CDs. You can actually put some money away safely and get a little better interest rate than the 0.05% that they've been paying for the last 5 years. So it's just a different tone to what we've been saying, which is, yes, cash is part of a good overall portfolio, but where is this cash at? Because if it's sitting at a savings account making 0 now, we still want some there, but we can be using other tools to get a little better yield out of that weren't available 18, 24 months ago. They weren't worth talking about like they are now. So.
And I guess that's a good point too, that we do have some clients that banks are totally appropriate for working with. Maybe they have absolutely no risk appetite. They don't want to take on the risk of the market, and they have well more than enough for retirement. That's not our typical client that we work with, but people like that do exist out there. So banks can be good institutions to work with. But from an investment standpoint, we like to engage the stock markets for that long-term equity growth. We'll get more into that here in a second. The other aspect out there is bonds and bond yields, because of course they're paying a little bit more than typically what you could get at banks with CDs or high yield savings accounts. But you might be surprised, US Treasuries on the aggregate isn't necessarily paying more than what you could get at your local bank, which is a bit of a surprise. But that's why we also engage markets like investment grade corporate bonds and high yield corporate bonds as well. You can see that you get a little bit more yield out of them over time, but it is something that you have to take on in the right amount, in the right proportion, because as you move down that rung to get that higher yield, you do take on a little bit more credit risk. So if one of those corporate bonds defaults on their payment, maybe they missed an interest payment, or maybe they missed 6 in a row, that's kind of the extra yield you get from owning those corporate bonds, because you're taking on a little bit extra risk aside from US Treasuries, which are backed by the US government, or CDs from a local bank. Very, very important pieces to your overall portfolio, but critical to understand the components to that as well.
I think it's easy to think of it as, someone with a low credit score that's trying to get a loan, well, they generally have to pay a higher interest rate, right? So a high yield corporate bond, so a company coming with, maybe not the strength of another organization, they're going to have to pay you higher interest for the amount that you've lended to them. So I think it's easy to kind of think of it from more of a consumer standpoint as well.
Yeah. The one other piece before we talk about kind of the stock market comparison is that these yields sound really, really good right now, but like we've talked about a few times already, these rates may not last forever. They may come down in the future. Right now, they're really competitive rates and they're really attractive. And that's why we utilize them in portfolios, is because they're an important piece. And this is a great environment that we're in. But it still doesn't take away from the impact and opportunities that the stock market has.
Yeah, I think it's for our retirees for the first time in about 14 years, they have the ability to get some yield and some return without having to take the risk of take on as much risk in stocks.
Yeah. So we'll step forward here to kind of the stock market and bond market comparison. And some of the key things that we're going to look at here is kind of really long dated returns information. So we're looking at time periods from 1970 to 2022 for these pieces. These slides here that we're going to look at, we're going to talk about 3 big pieces that we look at when we're looking for stock ownership within your portfolio. And these are just 3 simple points that kind of show the power of holding stocks over a long period of time. So first and foremost, we'll talk about is stocks typically rebound after market drawdowns. So we're looking here at this chart, or this table on the screen. We're looking at the last 5 decades. And we're looking at the worst loss in the stock market during that time frame, and then what happened 12 months thereafter. And you can see that not every time period we look at on the right, that stocks were the better performer over that time period. But you can see on average that stocks were the opportunity that bounced back pretty quickly thereafter. And not only that, it's a pretty big opportunity. We have a lot of clients saying, well, hey, let's stop it for now because there's just too much risk in the market, but we'll get back in when things are okay. A lot of times right after market drawdowns is the big opportunity for returns in the portfolio. A very common piece that's talked about is missing the best 10 days over the last 22 years. You would lose, and if you were invested in the S&P 500, you would have lost 50% of the portfolio value just because you missed out on those best 10 days. And the best 10 days typically happen right after the worst day in the market. And so it's very critical to not let the emotions drive what you decide on whether you're in the market, whether you're out of the market. That's kind of what we focus on when we look for long-term returns and staying strong when the markets decline. So the next piece that we'll look at here, we're going to look at a table on this slide and the next slide that are pretty similar. both looking at stocks and bonds. And we're going to look at this table in two different perspectives. So first of all, we're just going to look at the big piece. The reason why you own stocks is that stocks historically outperform bonds. It's a fairly simple concept looking at stocks over the past 53 years, earning an annualized return of 10.4% over that time frame. And then bonds, on the other hand, earning 6.8. So about a 4% difference there. And you might say, well, that 7% return that I could have earned on bonds sounds pretty good to me. I'll take that. It sounds good. But then on the right, if you look at that, we're looking at a portfolio value if you would have started on January 1st of 1970 with $1,000 in the portfolio. The comparison between a stock and a bond portfolio, you earn almost 6 times more in the stock market. And the reason that is because of the power of compounding interest, compounding dividends, compounding returns. They're very, very powerful. And those higher annualized returns that you get off the stock market really show the overall power of the returns that you can get over a long time period. From year to year, I mean, it's not great from year to year sometimes, but staying invested and staying in it for the long-term time period gets you those benefits. The next piece we'll take a quick look at is adding inflation in. So we add inflation into a lot of our returns analysis because it's important to get this concept of real returns. So you take the annualized return that you had and you remove the impact of inflation. I mean, looking at the 1970s, the value of a house is quite different in 1970 than it is last year. So you have to account for that. Because a return in a stock portfolio or a bond portfolio is impacted by inflation when you go to use that money. You no longer can take out all that money and buy the exact same house for the exact same amount of money that you could have in 1970. So that's why we're looking at this chart here now on the bottom. And the first part of it shows annualized real return. So pretty simply subtracts about 4% return from it to give you that differential there. You can see that bonds are still positive, which is a great thing. But you can then look at the ending portfolio value of that same portfolio, and you can just see the drastic impact that inflation makes on that. The difference between $191,000 in the stock portfolio versus $24,000, just accounting for inflation, it's a major impact. And it's one of the main reasons why we really drive home that stocks really help combat against that long-term inflation aspect. Year to year, you can have fluctuations, but over the long period of time, bonds keep up, but enough to kind of keep up and beat it out a little bit. To actually build wealth, to build that creation, a really, really important aspect is making sure that you have exposure to stocks so that you can build that compounding interest, that compounding dividends. And we'll dig into kind of why it's important, even when you get to retirement as well. So there we go.
Yeah, so we talk to clients about this a lot, especially as they get closer to retirement. I think people automatically assume, well, time to take all the risk off the table. I'm retired. I just need income. Let's make sure that we're not putting anything at risk. And I think that generally what we talk to people about is there's more than one type of risk, right? One type of risk would be, yes, volatility in the equity markets and the stock markets, right? So you have risk that year to year you may lose value in that investment. But another not so obvious risk is the risk of inflation, right? And inflation eating up your purchasing power, and from year to year, your investment's not creating enough excess income for you to adjust your spending with inflation and not run out of money in retirement, because retirement can last a long time. I mean, we have clients who've been retired for more than 30 years, right? And when you're looking at your portfolio needing to be able to withstand the withdrawals you want to take against it, it becomes really important to have equity exposure, because fixed income or bonds simply can't provide the amount of return you need over and above inflation to sustain a portfolio over a long-term retirement. So we're going to look at an example here. We're going to look at a 30-year timeline of retirement, and we're going to look at a portfolio that is invested fully in stock, or I'm sorry, fully in bonds, fully in cash, fully in stock, and then one that's a combination of what we would call a balanced portfolio. So about 60% in stock and 40% in bonds. Now, what we're looking at for this particular portfolio is they're drawing out 5% on an annual basis of their portfolio's value. So that's their retirement income portion of it. So that 5% or $5,000 withdrawal on a $100,000 portfolio, that's increasing each year with inflation. And so that 5%, if the portfolio doesn't continue to grow, just becomes more and more of the overall portfolio and could potentially make it run out of money before the client passes away. So let's look at that here on the next screen. And what we're looking here at in the upper left, you can see all 4 of those portfolios start in the same spot. So the orange line is that all stock portfolio. The green is the 60% stock, 40% bond. So the moderate balanced portfolio, that's the darker green there. The gray is the all bond portfolio, and the blue is the all cash. So what we're looking at on the left axis there is the balance of the portfolio. Again, we're all starting at 100,000, and then on the bottom, the number of years into retirement. And you can see here, if we have the client drawing $5,000 a year initially on a $100,000 portfolio, and all they do is have it in cash, they're not getting the returns they need to replace enough of what they're taking out. And you can see the portfolio actually goes to 0 in about year 16 there, right? And then similarly with the all bond portfolio, we're running to 0 in year 22 of retirement. And then you can see in the green and the orange, the balanced portfolio and the all stock portfolio, it decreases in value, but at year 30, the client still has, between $31,000 and $36,000 in the portfolio, because over a long period of time, stocks generally provide the level of return we need to add back in enough of what you're drawing out to make the portfolio sustainable over a long period of time. So I think, these 2 risks we've talked about, right? Volatility in equity markets and inflation risk. They're both real risks, and they're both important. So the way we need to address each of them is through diversification, not through anteing up on one versus the other. We need to address both of them. We can't just, stick with one.
I think one of the most interesting aspects on this slide here is the fact that a 60-40 portfolio in the stock market returned fairly similar over that period of time. I think that just goes to show the rationale behind the power of diversification and why we specify having multiple different asset classes in a portfolio. As one goes down, the other one goes up and helps balance out what happens over time. And of course, we have periods of time where that's not true, and you see them both go down at the same time. But that seems to be quite rare, and it doesn't get impacted as drastically when you look at very long periods of time. Over those long time periods, you do get that benefit of having different asset classes that work in different markets and provide stability while the other one provides long-term appreciation.
I think that's exactly it. I mean, looking at the balanced portfolio finishing there pretty closely to the stock portfolio, it's because we're taking income, right? If you were just looking at a portfolio that was just invested and nobody was taking money out of it, well, then stocks are going to be way more attractive, because over a long period of time, they generally outperform bonds, and we don't really care if they go down in the middle because we're not drawing money out. But the bond exposure provides the stability that we need to ride out those drops in the stock market and provide income for the theoretical client here. So you can see there's really a difference between what we would call like the accumulation period where you're saving for retirement and not spending, and the actual retirement timeline where we're drawing money out and we really value that stability. And from a total return perspective, it actually serves the client particularly well here.
Mm-hmm.
And I think, why we like the diversification and the balance. When you look forward and all that we just covered, in that you've got 60% in stocks, we showed you that the stock market generally recovers after a really bad year. So you've got exposure to the upside. But now that bonds are actually paying interest at 4 to 5%, where they weren't 24 months ago, you're actually positioned really nicely in that you've got some fixed income coming in, but you're also not taking the growth off the table for whenever this rebound does continue to occur and things like that. And this is so timely because everybody just got their September statements and seen it go down quite a bit, obviously, because that's when it always hurts. But it's important to remember that even as bad as it looks right now, look at your statement from the beginning of the year, and you're probably up, because the S&P 500 is still up for the year, even though it was down in August and September. So this is why these long-term timeframes put it into such clear perspective for people generally.
Yeah, it's actually gotten kind of fun to look at some of the statements for if you're looking at the dividends that are paid off of your fixed income bond funds, right? Those numbers have really kept climbing as rates has risen. So if you're looking for something to balance out the equity drops in the portfolio, take a little closer look at the transactions. It's pretty interesting.
All right, perfect. Well, I think that's everything that we had today. I think we've got a couple of questions that have been coming in. Go ahead and move on to some of the questions that we had. Again, if anybody has any questions, there's a little Q&A button at the bottom, and we can go ahead and read through those and answer them here. But we've got a few that have come in so far. So I'll read up the first one here. So I'm going to be retiring soon and was planning on downsizing. Should I hold off on buying a house? I think that is a very good question for our financial advisors to answer.
Yeah, that's a really good question. I think it's probably coming from the perspective of the housing market we sit in right now. But I would say for folks that are retiring and maybe downsizing, it's not a bad idea to consider kind of pausing. And certainly right now, selling and maybe renting for a year or two looks pretty attractive just from the aspect of not having to purchase a new home right away. But at the same time, sometimes people are selling their house in retirement because they're moving somewhere new. Maybe they're going to be closer to kids. Maybe they're leaving the Midwest to go somewhere warm. These are big changes in your life. Or even, just selling your home and moving to, a different part of town. So kind of having a temporary living situation, which, would be renting, it's an opportunity to decide whether or not you like that new style of living. Maybe you're moving from a single family home to an apartment or to a condo. Well, you may not like that. You maybe haven't lived in one of those types of housing situations. So you have this opportunity to have a temporary living situation, try it out, see if you like it, make sure you like the new city you've moved to or the part of town you're moving to. So I think right now, waiting on buying a house feels attractive from a cost perspective, but I think it also has some benefits just from a lifestyle perspective as well.
Yeah, it's a great point, Eric. I think it really comes down to what's the reason you're downsizing, right? Is it because you can't take care of the house, or you're just ready to move, or whatever the case is? Because you know what, you can always hire people to mow the lawn and hire a cleaning lady, that kind of stuff too, if it becomes too much to take in. But I love the idea for renting, especially for people that are like looking for that second home. Maybe they've always thought of snowbirding down in Florida or Texas or Arizona, wherever it is. And we have some clients that just jump in and buy a house right away and things like that. And it's like, oh, they get there and they're there for a year or two and they decide they don't like that area that they bought in. So they want to move to a different area, and then they're trying to trade houses and that kind of stuff. So yes, generally we want people to own homes and not rent, but in certain situations it makes a lot of sense because it's a lot easier just to pack up and go. And I have plenty of clients that like to snowbird, and they pay the check for the 3 months that they're in Florida, but you know what? They don't have to worry about the hurricane or all the insurance costs going up and all that kind of stuff too. So there is something to be said for that as well.
Oh, I think I was looking at some numbers recently about insurance premiums going up, and on the coast, they've gone up more than 20%. I think a couple of states hit 30% year-over-year increases in insurance premiums.
I mean, we're even seeing it here in the Midwest. I just got my renewals and I was wondering whose car and whose house they were insuring.
All right, well, let's look at the next question here. Should we be worried about an election year in the stock market? And I think this is a very good question, because that is something that is on our agenda for the next quarterly webinar that we're going to have. We have a fantastic slide that we'd love to bring up kind of before an election year. We figured that January might be the best time to bring that up. So we'll definitely be talking about that.
Yeah, I think just to give a little preview of that, I mean, so it doesn't feel like we're skirting the question too much. Historically, the market is pretty agnostic to which party is in the White House. And generally around elections, we will see maybe some increased volatility in the market, but generally we don't see long-term impacts from the specific event of the election, right? So there's far more to it, but I think just in the spirit of answering the question today, that's pretty good summary. But Kyle, anything to add?
No, I think that's exactly right. Like you said, it's primarily agnostic, and that's the important thing to take away. And, we get this question all the time, and we all live in this, constant news cycle where it's always something that's coming up and getting bombarded with different things. So, if even when it's not a presidential election, it was, 2 years ago was midterms. So how's that going to change it, right? So this question never goes away. So that's why we like to take a step back and focus. Like we said, in the next call here, we'll actually put some data to how the market's responded in the past going through these events and things like that. So.
All right. Well, that's all the questions that we had come in today. So thank you, everybody, for joining us today. We'll be back January. I can't believe it. 2024.
Goes fast.
Yeah. Well, thanks so much. And we will see you all shortly.
All right.
Bye.
Bye, everyone.